There's a seemingly unstoppable rise of housing prices, which continues to defy expectations even after multiple economic shocks over the past really 20 years. After the 2007-09 financial crisis, global house prices dipped by about 6% in real terms, but quickly rebounded. And that happened once again when COVID-19 hit. Experts predicted another property crash, but instead the market saw a boom as house hunters rushed to buy homes. Now, since 2021, central banks have been raising interest rates to fight inflation, though they did start dropping them more recently. And once again, fears of housing market crashes have circulated. But what does the reality look like? Well, prices only fell by about 5.6%, and now they're climbing rapidly once more. So why is this happening? Well, historically, housing wasn't always such a major asset class. The early 20th century, prices stayed pretty steady thanks to efficient construction and better transport infrastructure. But things started to change after World War II. Governments began subsidizing mortgages, urbanization increased, and new land use regulations made it harder to build homes. Now, a big part of the story is how the market has responded to recent interest rate hikes. Many homeowners have locked in fixed rate mortgages, those golden handcuffs before the pandemic, which has shielded them from rising rates. And so looking ahead, there's really three key factors suggesting that housing prices will continue to rise for years to come. The first is demographics. The rich world's foreign-born population is growing at a record rate. Immigrants need places to live, driving up both rents and housing prices. Even with stricter immigration policies, the need for housing will remain high as aging population demand care and services. Another is urbanization. Despite predictions that remote work would reduce the appeal of cities, big urban areas are still in demand. Jobs, social activities, and opportunities are still pretty concentrated in these major cities, and so that pushes up the competition for housing. Lastly is infrastructure. Poor infrastructure is definitely limiting people's ability to live further from urban centers. Congestion and slow transport improvements in cities like Los Angeles, where I live, are making commuting far more difficult, and that increases the demand for homes closer to where one works. So while some places have started to loosen restrictions on housing developments, the overall trend is that building remains slow, especially in cities where demand is the highest. And even though economic growth, interest rates, and other factors may impact the housing market in the short term, the long-term forces of demographics, urbanization, and really lack of improvements of infrastructure being the most important one in my opinion, are likely to keep pushing prices upward.